Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing AT&T stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. AT&T is one of the largest telecom companies in the world. They sold their Time Warner division to Discovery last year. That was really big news. A new company was created. That new company consists of 100% of Discovery plus AT&T's Time Warner division. The new entity was owned by 29% of Discovery shareholders and 71% of AT&T shareholders. If you want to invest in the new entity, the ticker is WBD, Warner Brothers Discovery. The current market cap is $35 billion, and they do not pay a dividend. I know that's a really big deal for AT&T shareholders, the dividend payment. That's why a lot of people who hold AT&T stock do so for that dividend. Historically, the company was really generous in their dividend payment. AT&T said the main reason for the divestiture is to become a pure-play communications company similar to Verizon and T-Mobile. Also, the margins are higher for its communications business versus its Time Warner division. The company is headquartered in Dallas, Texas, and was founded 40 years ago in 1983. The ticker trades on the New York Stock Exchange, Mexican Bolsa, Deutsche Börse, Zicha, Vienna, Swiss, Colombia, EuroTLX, Sao Paulo, Lima, and Buenos Aires Stock Exchange. Let's get started with the model. This is a large cap company, 131 billion market cap. They're trading at $18 a share, and they have 7.2 billion shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So this does not paint a nice picture. Free cash flow went down from 29 billion to 27 billion to 25 billion. Of course, you would expect their free cash flow to decline because they were losing Time Warner, and that got cut in half to 12.5 billion. It is hard to look at the actual numbers because they were a different company in 2021 versus 2022. So a way to find out if they're doing better or worse is to look at their ratios, the PE, price of sales. We'll look at that later. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that is up and down, a big positive to negative, a really big positive to a negative. And these negatives could be due to lots of write-offs because we can see they're generating lots of cash flow. In 2020, they reported a net loss, an accounting loss, but they generated over 27 billion of cash. That's why I like to follow the cash. It's much more important to follow the cash than to look at accounting tricks. Revenue is a sales for the company, and that's also been declining from 181 billion to 169 billion. Of course, there's a big drop in 2022 because they lose the Warner Brothers revenue. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit. And that was nearly 100 billion in 2019, down to 70 billion. But you should look at the gross margins and see if they're getting better or worse. The way you calculate gross margin, it's gross profit over revenue. It's how well you convert revenue into gross profit. Below that is their operating expenses. These are the expenses not directly related to generating the revenue, like marketing and research and development. Gross profit minus operating expenses gives you your operating income. And you could see that operating income wasn't that much lower in 2022 compared to prior years, but their revenue was a lot lower. So it looks like their operating margins are improving. And as you know, this company saddled down with tons of debt, more debt than almost any other company in the world. They paid over 6 billion of interest on their debt, which is a lot lower than 2019 of 8.4 billion. And the company did mention they were going to use a sale of Time Warner to pay down lots of debt. And it looks like they did. Then you have other income and expenses. These are all the gains or losses not part of the company's core operations. And you could see they passed through tons of impairments. 20 billion in 2020 and 20 billion in 2022. An asset impairment decreases the value of an asset on your balance sheet and you pass through the loss onto your income statement. but it doesn't affect cash flow. It's an accounting loss. Then you have your pre-tax income, your taxes, and the bottom line of the income statement is your net income. So you can tell the company was profitable because they paid nearly $4 billion of taxes, even though they're showing negative pre-tax income. Because when you calculate taxes, you have to strip out the asset impairment. And if you strip out this $20 billion, it looks like that pre-tax income should have been around $17 billion. So it makes sense to have $3.8 billion of taxes. So if you're a new investor, looking at the income statement can be really confusing. The statement of cash flows should clear up the confusion. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. So you could think of operating cash flow as net income converted to cash, because net income is your accounting profit or loss. It's not actual cash. So you can see they generate tons of cash. It's a cash cow. Over $30 billion in 2022, and that's a bad year. They had well over $40 billion before that, close to $50 billion in 2019. Some people have been in business for decades, and if you sum up all their cash flows over the years, they don't even come close to $30 billion. Then you have CapEx, investments in property, plant, and equipment. They spend a ton in CapEx because they have to build out lots of infrastructure for their telecom business. Operating cash flow minus CapEx gives you your free cash flow, and that's the cash remaining for you, the investor. That's how they pay such a big dividend. And they also use free cash flow to buy back stock and pay down debt. They only generated $12 billion of cash flow, but they bought back $3.5 billion of stock. They also paid a dividend, but look how much debt they paid down, $45 billion. How can they pay down so much debt with generating only $12 billion of cash flow? It was a sale of Time Warner. That's where they got all that cash from. They did pay down a lot of debt in 2019. They issued $21 billion, paid down $35 billion. So they decreased their debt load about $13 billion that year. They decreased it $8 billion in 2020, which is pretty good for a COVID year. But the following year, they increased it $24 billion. That's a lot of debt. But they paid down nearly $40 billion in 2022. So hopefully they're on the right path to become more profitable, reduce their debt, and get back to paying that big dividend payment. I think it was like 7%. Let's look at their capital structure. $98 billion of equity, $155 billion of debt. They're 39% equity, 61% debt. Their net debt is $151 billion. Net debt is debt minus cash on the balance sheet. And I gave them the highest whack on Finbox to be conservative, 11%, since they have so much debt. And that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $154 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $159 billion. We divide that by 7.2 billion shares. And we get a calculated stock price of $22. They're trading at $18, so they're trading at a 17% discount. It's a buy according to the model. Their revenue forecast for 2025 is $126 billion. For 2024, it's $124 billion. For 2023, it's $123 billion. I continued this trend into 2026, and I got $127 billion. That's how I got their future revenue estimates. To get their future free cash flows, I need to see what percent of their revenue they convert to free cash flow. So I summed up these 4 free cash flow numbers, and I divided by the sum of these 4 revenue numbers. That comes out to 15%. So I multiplied their future revenue estimates by 15%. That's how I got their future free cash flows. I tried to be really conservative, and it still undervalued the stock. If I was less conservative, my valuation would have been $40 or $50. But even in a really bad situation, the stock still seems like a pretty good value. The website Simply Wall Street is really bullish on this stock. They're at $48 a share. They're saying it's 61% undervalued. 12 analysts priced this stock, and the price target is $22. The low is $19, the high is $25. Another 20 analysts priced this stock, and their 1-year price target is $21. So they're saying the stock is 15% undervalued. So most people seem to be saying the stock is slightly undervalued. This is where the stock has been trading the last 5 years. Although it does look a bit volatile, it stays in a fairly tight range. The low was at the end of 2022. It hit about $15, $16. It was getting close to $30 in the third quarter of 2019. But you get a really nice dividend payment each quarter, which is why most people do invest in this company and stay invested. If you put money into this company 5 years ago, you'd be down 30%. But if you add the dividends in, you probably wouldn't be down that much. On the other hand, the S&P is up 52% in the past 5 years. Back in 2018, they were paying a 50-cent dividend, and they raised it pretty much every year up to 52 cents. Then they reduced their dividend when they divested Warner Brothers Media. Now they're paying 28 cents a share, which is still a nice yield over 6%. They could afford that. It's 64% of their free cash flow, but we can't look at that payout ratio because they have negative net income because of all those write-offs. And this is definitely not a volatile stock. It has a beta below 1, so it moves less than the market. It's up 6% in the past 52 weeks, while the S&P is down 13%. The 52-week low is 14, the high is 22. And the stock is on a decline, trading below its 50-day and 200-day moving average. And this is a really popular stock. Well over 30 million shares are traded each day. Almost all the shares outstanding are on float. 56% are held by institutions, and only 1% of the shares are shorted. Here's a chart of their dividend yield since 2013, and they've always paid a healthy dividend. It was over 8.5% at the end of 2021. The forecast is for their yield to be flat around 6% into 2025. This company's CEO makes a pretty penny, $2.4 million annual salary, $25 million total compensation package. About half the company is held by institutions, half by the general public, a very small amount by individual insiders, and an even smaller amount by the government. Vanguard is the biggest shareholder. They own 8.5% of the company, then BlackRock, State Street, Newport, and Geode. They employ lots of people, almost 300,000 people back in 2016. But it's been going down ever since 2019. They're currently at 161,000 people. The best way to look at ratios is to compare them to companies in the same industry. There are 50 companies in the same industry as AT&T, and they're the fourth largest company in terms of market cap. T-Mobile is the largest at $181 billion, then Comcast, then Verizon, then AT&T. Then it drops off quite a bit after AT&T. Besides Verizon, they spend the most in terms of CapEx. Their debt-to-equity ratio is average. They pay a really nice dividend, much higher than average. They generate lots of free cash flow. Their market cap is a lot higher than the average. They have a good price to book. So they have a good balance sheet. We can't look at that PE since they have negative net income. They have a really good price to sales of 10.6, much better than T-Mobile, a little better than Comcast and Verizon. Price to sales is really good. They generate lots of revenue. Although they're not growing, they're declining. Their 5-year annual revenue growth rate is negative 6%. And their ROA and ROE are negative because they have negative net income. So to summarize, I have them trading at a 17% discount. And if you're looking at 2x, 3x, 4x your money, this is not the stock to do it. But if you're looking for a stable return year after year, this is your stock. This is a great long-term hold. I don't think the company's going anywhere. They've been around a long time. They're a huge part of the US economy. But they have been struggling, and they have made some poor decisions over the years. I rank their free cash flows 5 out of 10, their revenue 4 out of 10, and their ratio 7 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.